Welcome back to Accounting Matters, the podcast where we break down the latest developments in financial reporting, standard setting, and everything in between. I'm your host, Nicole Harger, a senior managing director here at Embark. And today, we're diving into the current state of accounting standard setting in 2025, straight from the front lines of the FASB's agenda, from modernizing outdated guidance to responding to the needs of public and private companies alike. The FASB's 2025 work plan is full of meaningful projects aimed at improving clarity, consistency, and relevance in financial reporting. To help us unpack what's happening and why it matters, I'm joined as always by my co-host and accounting policy aficionado, Adam Olsen, Embark's head of firm quality. Adam, before we get into the specific projects, what's your overall take on the standard setting environment this year?
Aficionado, that's a new one. No, but all jokes aside, you are right. It's been, I guess even starting last year, been an active kind of cycle for the FASB, and we're seeing that continue into 2025. I think, obviously their goal is always to make financial statements more decision useful, especially as we're seeing more demand from various stakeholders around just the need for more transparency. Yep. So the FASB's current project portfolio, I think, reflects that shift. You mentioned the mix of modernization and forward thinking. There's a number of initiatives on the board's agenda, but I think for today, we're going to kind of hone in on three specific projects or three larger projects. I think that we feel like impacts multiple companies across, a variety of different industries and sectors. And so for today, we're going to dive into specifically kind of looking at the FASB's project on the overhaul of kind of software cost accounting, which is really looking at some of the existing guidance and whether or not that should be replaced. We're then going to turn the conversation over to the FASB's project on environmental credit programs, which, I think is becoming a bigger topic, more of a hot topic for a lot of companies as, they're kind of moving towards a variety of sustainability goals and the impacts that carbon offsets and credits can kind of have on those strategies there. And then we'll wrap up today, diving into the accounting for government grants, where the board is really trying to develop some specific U.S. GAAP guidance, where historically we've relied on a lot of other guidance by analogy to address the accounting in those situations. So a lot of different things that are really addressing kind of a lot of real world challenges that I think companies are facing. So excited to dive in and start hitting on those projects.
All right. Well, let's kick things off with the one that hits nearly almost every business in today's digital economy. So accounting for software costs. So right now the guidance is fragmented. You've got one model under ASC 350-40 for internal use software, and then you have another one under ASC 985-20 for software intended for sale. And so applying the right framework can be tricky, especially with how much software development has changed in recent years.
Yeah, exactly. And the current model that you referenced, right, that obviously developed a number of years ago. That guidance has been in effect for a while. And it was really developed when we had more of what was kind of called a waterfall method of how software development occurred. So it was a lot, back in the day, a lot more linear, sequential. You had specific stages that projects moved through, and the guidance reflects that, right? But if you fast forward to today and kind of the way modern development works, we live in a much more agile world. And so software really gets built in a lot of short sprints. There's requirements to evolve and kind of change things sometimes midstream in those projects. And you have a lot of rework, that used to be kind of an exception. And now it's almost expected you're going to have a lot of pivots during the project plan. And so that is really creating, I think, a disconnect in what the FASB is hoping to kind of address and why they're revisiting this guidance, right? So back in 2021, it's when stakeholders responded to the board's kind of broader, and they always do these kind of invitations for, comments and consultations for their agenda. And this was flagged as an area that they wanted the board to dive into. So looking at the software cost guidance, because people more or less said, hey, this feels outdated. This is operationally challenging given the way, modern projects work, especially if you think about like a SaaS-based kind of company and some of the models that they're developing. And so the board, took that feedback, started working on this project, I think back in 2022, kind of the summer of 2022, really focusing on modernizing the accounting for internal use software under, like you said, ASC 350-40. I think one thing that's important to note is there was also an initial push maybe to look at the guidance for software that's going to be marketed or sold. And they, elected, at least in this project, not to include that in the scope of what they would be evaluating here. So the existing guidance under 985 will remain in effect, and it's not in the scope of this current project.
And so the proposed ASU that was issued in late October of 24 kind of reflects that more measured approach. So the big change being no more prescriptive project changes.
Yep.
So FASB is eliminating the preliminary application development and post-implementation phases that were originally designed around kind of that waterfall that you talked about.
Right.
So instead, what they're doing is they're proposing 2 key criteria that must be met before an entity can begin capitalizing software development costs. The first is management has to have authorized and committed to funding the project. And then it must be probable that the project will be completed and that the software will be used as intended. So obviously, that second part, probable to complete threshold, is kind of where things get a little interesting. The proposal aligns the term probable with the ASC master glossary definition, which means likely to occur. But it also introduces the idea of significant development uncertainty, basically saying if there's too much uncertainty about whether the software will actually get done, then you can't capitalize yet.
Yeah. And so that's obviously introducing a level of judgment here, right? So if you're, think about it, if you're building something highly novel or unproven, or you've got a lot of key performance requirements that are still kind of shifting around in a very dynamic project, kind of under that premise, right, you likely could still be in the category where you're having to expense those costs. And so if you think about kind of major SaaS platforms and their development, that could have a major impact on them as well. And so I think that's just one thing that industry is kind of looking at under the proposed. Obviously this standard is proposed, but, where that could introduce some judgment and maybe create some complexity in hey, we may actually have so much uncertainty that we're having to expense a lot of those costs.
Yeah, so it's kind of a double-edged sword there, right? So on one hand, it reflects how companies actually build the software today. Mm-hmm. It's flexible, it's iterative, and sometimes uncertain. But on the other hand, it's introducing a new judgment point that could vary widely across companies.
Yeah, that's true. And in fact, the FASB acknowledged while they were aiming to reduce complexity by removing kind of that standard stage model that you walk through there, they're also aware that applying this probable to complete test, like I said, especially in those agile environments, it's going to create judgment, like I mentioned, but every time you introduce more judgment, inevitably, sometimes that can lead to more diversity in practice, just how people are applying those judgments. But they're also adding some examples to help guide companies through, I think, some of that gray area, at least in the proposed standards. So for instance, if you're customizing a widely used ERP platform, there may be minimal development uncertainty and you'll likely be able to meet that threshold sooner. But if you're building out, especially in today's world, a lot of the AI powered functionality for an external platform and maybe a lot more uncertainty there about the probable to complete, you might be looking at longer periods, like I said, of expensing those costs before you can actually start to capitalize.
And so I guess speaking of practical implications, let's talk about financial statement presentation.
Okay.
So one of the more concrete changes in the proposal is how companies would have to present cash flows related to capitalized software costs. So the proposal would require that cash paid for capitalized internal use software be presented separately as an investing activity on the statement of cash flows, so not lumped in with other investing outflows. And this change specifically is directly tied to investor feedback. The board heard loud and clear that this level of visibility, especially as software spend does become more central to business strategy, would be decision useful information.
Yeah. And just to clarify, this requirement only applies to actual cash paid. So if there are non-cash components, right, like stock-based compensation or accrued software license costs, those would still be disclosed as kind of non-cash investing activities, no different than how we think about other non-cash items under our normal cash flow guidance. It's also worth noting that the board did not propose new income statement presentation guidance for these expense development costs. So if a company doesn't meet their capitalization threshold, kind of like what you just walked through there, they're still going to apply the existing guidance that's out there in ASC 730 or make judgments on how they want to present those costs. So, oftentimes they're categorized as research and development type costs, or maybe just kind of rolled into general SG&A.
Yeah. And I guess another area kind of tucked into the proposal a little bit is the elimination of subtopic 350, which covers website development costs. So instead, the relevant guidance is kind of being folded into ASC 350-40.
Yeah, and that makes sense. It's pretty straightforward there. No one really, I think, thinks about website development until today as a kind of a standalone area, right? It's usually kind of blurred into just general software development. So having a separate section, I think, within the codification, doesn't really make a ton of sense. And so this is really just kind of reducing some of that fragmentation in the guidance and streamlining that guidance overall.
Okay, so let's talk about transition and effective dates.
Okay.
How does the FASB plan to implement this?
Yeah, so in the proposal, right, they kind of outline two options for companies to consider. So you can, apply the amendments retrospectively, which, as we know, means you have to kind of go back and adjust prior periods and record a cumulative effect adjustment to the opening equity of the earliest period. Or, conversely, you can view it from a prospective kind of lens, meaning that the new guidance would only apply to costs incurred after the adoption date, included ongoing and in-process kind of projects there. And so the perspective method mirrors the approach that's allowed under ASU 2018-15 that we had for cloud computing implementation costs several years ago. And I think for most company, it's likely to be the more appealing kind of option, right? Just a little bit less cumbersome for companies to have to navigate. So I think just from like a resource perspective, that's most likely the route we'd expect clients to go.
Yeah. And then I guess as of now, the FASB has not kind of set an effective date yet. They're going to wait until kind of they've reviewed stakeholder feedback. But they have indicated that early adoption will likely be on the table, which could be a strategic move for companies looking to align kind of earlier with the updated framework.
Yeah, and especially if you think about if you're in a company or an industry that's going through a significant kind of software spend period, or if you're in the middle of some type of large scale system development or rollout or whatever the case may be, I think adopting early might be an advantageous option because you can start applying those new thresholds that you mentioned, hopefully from project inception versus like having to kind of pivot midstream in a large project if it's kind of a multi-year thing between different sets of guidance, if that makes sense.
Yep, it does. I think that's a good point for companies to be thinking about.
Yep.
Let's shift gears, to the next kind of big ticket project that's gaining a lot of traction in 2025, accounting for environmental credit programs. So this is one that's been a long time coming, right?
It has. So, the idea, I think, of regulating emissions and incentivizing environmental improvements through credits, that's been around for a while, right? We've seen that for several years. You think about kind of cap and trade programs that are out there. You've got RECs, because of those renewable energy certificates that are popular. But what's new is that kind of how mainstream some of these credits have become across a number of different types of companies and industries, right? They used to be maybe a little bit more segmented as far as kind of who was having to deal with that. But as we're seeing evolving kind of strategic decisions and strategies for companies, they're becoming more prevalent, I think, across a number of industries. And it's really not just a tool for compliance like it may have historically been, right? I think there's some strategic view that these are, important assets that can be used to help manage sustainability goals or targets that companies may have set. There's also, we're starting to see more markets for some of these items. And so there's a way to even kind of monetize some of these different types of credits, or there's, more increasing investor expectations around how companies are either using these credits or investing in these types of credits or whatever the case may be. And so, all of that said, and I think the biggest issue is that historically there's been little to no specific U.S. GAAP guidance on this topic. And so this is where the FASB is now stepping in to help address that.
Yeah. And so kind of in the absence of clear rules, companies have been sort of piecemealing it together, analogizing to inventory and tangibles and even marketing costs. So that patchwork approach has really led to a lot of diversity in practice and honestly some confusion. So December 2024, the FASB did issue a proposed ASU to kind of bring order to the chaos, if you will, introducing topic 818, which is to standardize accounting for environmental credits and obligations.
Yeah. So in this proposal, the scope of, topic 818 is pretty broad, right? It covers credits that are acquired, granted, or internally generated as long as they're enforceable rights, separately transferable, and used to reduce, remove, or control pollution or emissions. It also covers environmental credit obligations, so on the liability side of things. So things that if you think about like requirements under a cap and trade program, renewable fuel standards or emission caps, those are also pulled into this kind of proposed new standard. What's not in scope, just to clarify here, so any types of tax credits that are kind of related in the same space, those are not they would not apply this, this proposed new guidance. Those would still kind of fall under existing GAAP in 740. So just to clarify that.
Okay. So let's talk through the recognition model for credits. This is where the FASB kind of took an intent-based approach.
Yeah. So the recognition model really depends on how a company, like you said, intends to use those credits, right? So if it's probable that the credits are going to be used to settle an environmental credit obligation, or they're going to be transferred in some type of exchange transaction, then you're going to recognize those credits as an asset on your balance sheet. If the probability threshold is not met, so let's say you're holding them for some type of voluntary climate goals, but you really don't have a plan exactly how you're going to use those, then those costs will get expensed as incurred. And that's a key distinction here, right? Just because you hold a credit doesn't automatically mean that, at least under this proposed guidance, that you're able to capitalize it on the balance sheet. So, a strong distinguishment there.
Yep. And so once a credit is recognized as an asset, obviously the next question becomes, how do you classify and also measure it? This kind of brings us to compliance versus non-compliance credit.
Yeah. So let's break down at least how the FASB in the proposal is thinking about the difference between compliance and non-compliance. So for compliance credits, those are ones that are expected to be used to settle kind of an environmental credit obligation. And in that case, they would be measured at cost. They would not be tested for impairment. On the other hand, the non-compliance credits or everything else that's recognized as an asset. So these are going to be credits that are typically held for sale, or like as we mentioned, there's a lot more active markets for these credits. So we're seeing a lot of trading of them as well. In that case, these credits would be measured either at cost or fair value, but they would be tested for impairment kind of at each reporting period. One thing to also note is that both types of these credits are not amortized, and companies can make an accounting policy election to remeasure eligible non-compliance environmental credits at fair value on a recurring basis.
And there's also even kind of flexibility around the costing method. So entities can use an average cost, FIFO, or specific identification depending on what's appropriate. There's also a portfolio approach allowed for sufficiently similar credits as long as the risk of loss on derecognition is low.
Yeah, and I think it's worth noting too, as we mentioned, like if you don't have a plan for those credits, right, and you're under the proposal, you would be expensing those credits. One thing to keep in mind is that you can't reverse that. So like as you kind of time goes on, like obviously your intentions probably change or become more solidified, you aren't able to reverse that expense, right? So I think this really puts pressure on that initial evaluation. Meaning companies, I think, are really going to have more robust kind of processes and accounting policies and even kind of controls just around how they kind of do that evaluation for these credits.
Okay, so let's shift to the liability side of the model, because the guidance doesn't just stop with credits. It also introduces a framework for environmental credit obligations, or also ECOs.
Yeah, and this part mirrors some of the logic that we see with other kind of specific obligation guidance. So if you think about asset retirement obligations, but obviously this guidance is more tailored for kind of the emissions-based compliance schemes that we see. So under the proposed ASU here, companies would have to recognize the liability once an obligation exists at the reporting date. And kind of here's the important piece that you want to keep in mind is that the measurement of that liability is split between a funded portion and an unfunded portion. So the funded portion is measured using the carrying value of any on-hand compliance credits, and the unfunded portion, when you more or less don't have enough credits to satisfy that obligation, is going to be measured using the fair value of credits you would need in order to settle whatever that shortfall might look like. There are some nuances here. So for example, if a company has an unconditional right to receive credits at a fixed price, those can reduce the fair value component as well.
And so if a company intends to settle in cash, they'd be measuring the liability based on the cash settlement amount under the compliance program. So there are multiple paths depending on what resources the company holds and kind of how it plans to meet its obligations.
Yeah, exactly. And similar to asset recognition, the model calls for reassessment every reporting period for both the credits and the obligations. So if your intent changes or circumstances shift around those credits, the accounting is obviously going to have to reflect those changes as well.
Okay, so before we wrap this segment, let's touch on presentation and disclosures.
Perfect. So we can start with the balance sheet, right? So the proposal does make it clear that entities must present their environmental credits and their related environmental credit obligations on a gross basis on that balance sheet. So this means that you can't offset the liability with any credits that you plan to use to settle that obligation, right? So for example, if you had $10 million worth of kind of those environmental credit obligations on your balance sheet, and you had $8 million or so of kind of qualifying compliance credits that you could use to offset them, you're still going to have to show the full liability and kind of that full asset balance separately.
Okay, and that's really because those credits are still assets that you could theoretically sell or trade, even if you do intend to use them to settle the liability. There's too much optionality for net presentation to be appropriate, and so it avoids misrepresenting the company's actual resources and obligations.
Yeah, exactly. And so for classification, I think this is pretty straightforward here, but just to clarify how the proposal works. So if the credits or the ECO liability are reasonably expected to be remitted or settled within a year, you're going to classify them as a current asset or liability, and then anything outside of that is going to obviously go to non-current. And this goes as well for credits that are intended for sale or trade. So current if that's going to occur within 12 months, and then again, it'd be non-current otherwise.
Okay, and so from a cash flow perspective, the proposal actually doesn't add a lot of specificity. No new presentation line or required classification. So entities would continue using existing cash flow guidance and principles, likely classifying purchases or sales of credits as investing or operating activities, depending on the company's facts and circumstances.
Yep, but I do think where, so don't have a lot of cash flow guidance, at least in the proposal, but where the proposal does get a bit more prescriptive is kind of in the disclosure requirements, which probably isn't a big surprise here. So there's a lot that they're suggesting that companies would need to provide in terms of added transparency just around these assets and liabilities. So from the credit side, so looking at the asset side, the proposal highlights that companies would need to disclose how those credits were obtained. So were they acquired? Did you internally generate them through some type of projects that provide for credits? Were you granted them by somebody, or did you receive them in some type of non-reciprocal transfer? So what are the circumstances there? Then you need to disclose how you plan to use those credits or intend to use them if you're not sure. So is it going to be to help settle an obligation? Are you just holding on to them for some voluntary goals that you may have? Or is there an intent to to sell them or trade them. And then kind of the costing methodology, like you mentioned. So, how are you applying the costing methodology here to those credits? So is it a FIFO method, average cost, specific identifications, stuff we kind of see similarly around inventory. And then if you're using a portfolio approach, which the proposal does provide for, just how that portfolio is defined and you're applying that. And then where you're intending to apply kind of any fair value measurements, you're going to have fair value disclosures around some of those non-compliance credits if you're going to apply that approach.
And then for ECO liabilities, and these are going to have to disclose the types of compliance programs, the activities that trigger the obligations, and how the unfunded portion is measured, as well as details on each significant ECO, including jurisdiction, funding status, and measurement. Total expenses broken out between current period emissions and remeasurements of previously recognized liabilities.
Yep.
And then any amortization of prepaid type assets related to the obligations that arise just from existing as a business, like a fixed compliance fee based on status, not activity.
Yeah, and the proposal, is going to require these disclosures both on an interim and annual basis, obviously where they're material to the company and their financial statements as a whole. And again, like we've talked about at the start of this episode, really is this all around kind of the premise that the FASB wants to provide more decision useful information, and it's particularly for these environmental credits around kind of volume valuation and kind of what are companies' intentionality around the programs that they're kind of entered into.
And so before we move on to our next topic, let's quickly touch on transition and effective date.
Yeah, so just kind of short answer here, the FASB hasn't finalized an effective date yet. We talked about the kind of the volume of stakeholder feedback. I think next steps obviously is going to have to be evaluating some of the comments that were received and going through that, and thinking about any changes that they may want to still make to the proposal and figuring out what an effective date will look like. But when entities adopt this, they will use a modified retrospective approach. At least that's how it's outlined in the proposed ASU now. So this more or less means that you will assess environmental credits as of the initial application date, classify them kind of based on your current intent, I guess, and then record a cumulative effect adjustment to opening retained earnings. You're not going to restate prior periods, so it saves a little time there, which, like I said, just helps reduce costs and complexity for accounting and finance teams.
Okay, so I think that kind of ends the discussion on environmental credits. Let's wrap up today's discussion, turning to kind of a long-awaited update from the FASB, which is the proposed guidance on accounting for government grants.
Yeah, and this one, like we said at the beginning, I think it fills a major gap that existed in U.S. GAAP. So until now, there's been no specific guidance that really addresses this space on how to either recognize, measure, or present government grant. So historically, companies have analogized to other guidance. So whether that's kind of the IFRS guidance that sits in IAS 20, or in some cases, people have also kind of analogized to some not-for-profit contribution models that exist under ASC 958. And this was, this topic of the conversation came up a lot during kind of the COVID time, when there were a lot of government assistance programs out there that companies were entering into, and everyone was like, what do we do with these funds? How do we account for this? And so I think it really highlighted kind of this missing link. And so back in 2021, so, kind of we were winding through COVID. This is where the FASB took an initial step, and they issued an ASU that really kind of focused on some of just the disclosures around government assistance and what companies should at least be presenting to users through the disclosures on this. But they didn't touch on any recognition or measurement guidance in that ASU. And so that's what now this proposed ASU is looking to address.
Right. And so under the new proposal, topic 832 would actually be renamed from government assistance to government grants, and then the guidance would apply to all business entities with the exception of nonprofits and employee benefit plans. So let's kind of talk about what's in scope.
Okay. So in scope, what you have here is monetary and tangible non-monetary transfers from governments. So this can be cash or physical assets, just depending. In most cases, it's probably cash, as long as they're non-exchange in nature, right? So if you're receiving something without directly giving equal value in return to the government, it's going to likely fall under the scope of this guidance. So conversely, what would not be in scope? So any exchange transaction. So you are exchanging things. So if you're providing goods or services to a government entity in exchange for cash or other assets, like that's going to just follow your normal 606 revenue recognition type guidance or your ASC 610 guidance. Income tax related items are still going to stay within the codification under 740, below market loans, government guarantees, intangible assets or services, and then environmental credits, like what we just talked about. So even if those are kind of facilitated through a government program, they're still going to fall at least under that proposed guidance that we just walked through. So those are some areas where there's exceptions to applying this government grant guidance.
Okay. And so let's talk about recognition.
Okay.
The proposal uses the probable threshold again, right?
Yeah, so in this instance, you would recognize a grant, like you said, when it's probable that two conditions are met. So one, the entity will comply with the grant's conditions, and two, the grant will be received. So this is really in line, this probable guidance, like other areas of GAAP where they use the word probable. So it really means likely to occur. And this is really also kind of consistent, I think, how the SEC for public companies interprets kind of the reasonable assurance language that is used by analogy under IAS 20. So I think the good thing here is if you were already kind of analogizing to that guidance, the IFRS guidance for your government grant transactions, you're not going to likely see a lot of change here with applying this probable guidance.
And for forgivable loans from the government, they also fall under this model if the company expects to meet the forgiveness criteria, right?
Correct. Yeah. So if you expect the loan to be forgiven and it meets those two conditions that we just walked through, then you're still going to treat it as a government grant.
Okay. So let's break down the accounting models because this is where the FASB offers some flexibility. Grants can be related to assets or related to income, and each path kind of has different options.
Yeah. So we'll start with the first one. So grants related to assets. So these are, what does that mean? These are grants that require the company to purchase, build, or acquire certain long-term assets. So in this circumstance, you kind of got two options that you think about from kind of a measurement perspective. You got the cost accumulation approach, which basically means that you're going to reduce the carrying value of the asset. So effectively, the grant would be netted against the cost of the asset, and you would recognize that benefit over time. And that would just kind of come through a lower level of depreciation expense. The other alternative is the deferred income approach. So here you would treat the grant as a separate deferred liability, and you would recognize income systematically over the kind of the asset's useful life, right? So you just kind of amortize that deferred liability, and this would be in line with the expenses it helps to offset. If the grant is in the form of kind of a non-monetary tangible asset, so like if you're instead of cash, you're given land or equipment or some other type of tangible asset, you would measure it at fair value under the deferred income approach, or at a nominal cost if you're going to apply that cost accumulation model.
Okay, and so for grants related to income, like reimbursement of operating costs, same recognition threshold applies, but these are always treated using the deferred income approach?
Yeah, exactly. So you recognize the grant and earnings over the period that the related expenses are incurred. So if you receive a grant to help, like cover payroll costs or utility costs or whatever the case may be, you recognize the income as those expenses happen. So it's either going to be presented sometimes as other income or as a reduction of that related expense. And that's where a company typically makes an accounting policy election on how they're going to present that.
So there's also guidance on repayments, right? What happens if you fail to meet the grant conditions and need to give the funds back?
Yeah. Unfortunate situation, but good point to raise. So if repayment happens after the grant has already been recognized, it's going to be treated as just a change in estimate. So you're going to follow guidance under ASC 250 for kind of changes in estimates there. So if we think about the two different types of grants, so for income grants, you would first reduce any deferred income balance. If there's an excess repayment, then that's going to hit earnings immediately to kind of bridge that delta. And then for asset grants, repayment is going to either increase the carrying value of the asset if you were applying that cost model that we talked about, or it's going to reduce the deferred income liability if you were applying that deferred model. So you'd also have to recognize any kind of catch-up depreciation or impairment that could result as from that change in estimate.
The proposal also includes guidance around business combinations, right?
It does. And I think it's thoughtful that they included considerations around how you treat this in a business combination. So if the acquiree has already kind of complied with those grant conditions, no deferred income is going to be recognized in that kind of applying that purchase accounting guidance.
So does it just get written off?
Yes. Yeah. So that'll be written off. And then, however, if they do have a liability to repay, that's going to be handled under kind of contingency guidance that you would apply in ASC 450. If the conditions haven't been fully met, then the acquirer is going to account for that grant based on whether it's related to an asset or related to income. So which kind of model are you applying? And then you would use the proposed measurement model that we just walked through in this topic, 832. So this is really going to change to some targeted guidance that you already have in ASC 805, but it really addresses kind of this fact pattern.
Awesome. So let's wrap this section with the transition options and kind of what companies need to plan for.
Sure. So the proposal gives two options, which is, I guess, is nice. So you got the prospective application here. So this applies to grants that are still active at the adoption date. And then obviously for any new grants you have going forward, probably this more simple method to apply there, but also retrospective application is available under the proposal. So if you select this, then obviously you're going to have to go back and restate prior periods and record a cumulative effect adjustment. The FASB is also going to determine the effective date and whether they will allow early adoption. I'd be surprised if they didn't after they review, again, stakeholder feedback through kind of the redeliberation process on this project.
All right. Well, that brings us to the end of another episode of Accounting Matters. Today, we covered a lot of ground and some major developments in the FASB's 2025 agenda.
Yeah, we sure did. So from, just recapping kind of what we did here, modernizing software cost accounting that we talked through at the start, to kind of introduction of a new full framework for environmental credits and obligations. And then, like I said, just walking through what we did here around government grants, I think it's clear the board is trying to bring a lot more structure and consistency to, I think, areas of I would say gap, but some of those didn't even have gaps. So just transactions and kind of just things we're seeing companies having to sort through that historically have been open to a lot of diversity and interpretation.
And so as we've discussed, these upcoming changes to financial reporting could shift the way you handle everything from software costs to government grants. So it's really a great time to get ahead of the curve.
Yeah. And, obviously, if you need help navigating these changes or really any accounting standard changes, we at Embark, this is stuff we do day in, day out for all of our clients across all different types of industries, tackling all sorts of problems. So we're always obviously here to help companies strategize and implement the right solution that's needed for them.
Yep. And you can always reach out directly to us or connect with us on LinkedIn for further discussions.
Yep.
Thanks for tuning in to Accounting Matters. And don't forget to subscribe